All right, guys, welcome back this week. We're going to talk about some big picture retirement decisions that could be working against you. And I'm going to start with just asking a basic question. If I could put $300,000 back into your pocket, would you listen all the way to the end of this video? See, because what I'm learning by watching retirees doing what everybody else is doing is they don't love what everybody else is getting. And I'm going to tell you where it all starts. It starts with the retiree's tax return. How much income you report on your tax return when you're retired determines about 14 different taxes. I'll just give you a quick list of some examples. How much capital gains tax you will pay, how much your Medicare premium will be, how much your Medicare surtax will be, how much of your Social Security is taxable, how much of your charitable giving is deductible, how much of your savings bond interest will be taxable. Short list out of a long list, but my point here is we're putting income on our tax return as a retiree. And when we do that, it's a very different experience from your working years. And I'll ask you this, do you find it more easy to manage your income or your expenses? Put another way, does a business owner have more control over his top line revenue or his cost or her costs? See, there's a whole lot more opportunity in minimizing loss than there is chasing gains and rates of return when it comes to retirement planning, and that's today's big lesson. So what I'm putting down as income in my retirement is going to determine all of those different taxes I pay. And if you understand how we generate retirement income, so if the general premise is I have a account, a nest egg, if you will, and I'm withdrawing from that nest egg each and every month to pay my bills and to fund my lifestyle. So from that perspective, cash flow is king. We have to understand how much cash flow we need and then understand how much of an account does it take to actually generate that cash flow. And what we find is using a 3 to 4% withdrawal rate, every $1,000 of tax or expense that I can minimize or eliminate in retirement frees up $30,000 of nest egg for me to spend my own way. Or put another way, it's $30,000 of nest egg that you don't need in retirement. So hopefully that's a light bulb moment, because I think, retirement is expensive and it's complicated, but some of this stuff is self-inflicted. And if we understand the rules of the game and how to play them, those who understand the tax code pay the least taxes. Those who don't foot the bill. So if I were to estimate a Social Security tax, typical family goes into Social Security and they have to pay taxes on it because their taxable income in retirement is too high. Just to kind of kick off an estimate there, that's about a $10,000 per year tax or money lost that you didn't have to lose. So by our own math, if I have to pay out $10,000 of tax for Social Security, it takes between $300,000 and $400,000 of portfolio value to kick out that type of cash flow. So, for folks that get to retirement and they have $300,000 to $400,000 in their 401k or their IRA, you absolutely cannot afford to have taxable income on your tax return. The tax on the Social Security alone will take up all of your portfolio's spending power. See, there's only one real reason to save money. And when we talk about retirement planning, it's pretty simple. It's because we're going to spend money in the future. So does it make sense that we should focus on how something accumulates or how it spends? And the answer is spends. So when we do spend our money in retirement, where does it come from? Well, if it's coming from an IRA or a 401k or a pension, those are all places where you're going to have to pay ordinary income taxes, and that is going to put you on the radar for paying taxation of Social Security, taxation possibly additional of Medicare, losing out on a lot of other taxable benefits. So we're taking actions, or we're doing things that are causing us to have dollars confiscated from us that wouldn't have otherwise left our personal economy. So if all I had was Social Security and I had no other income, well, there'd be no reason for a tax return. I just have one source of income and it's not taxable. When I start adding taxable income to my tax return, that's where it gets interesting, because the government feels if you've saved your own money, then you're not necessarily entitled to all of the benefits and savings that were promised to you. So really, what it comes down to is what we're building and how we're building it that creates all of the problems that we tend to see in retirement planning. Don't want to pay a bunch of taxes in retirement? I mean, when is paying taxes enough? You pay taxes your entire working career. But if we've chosen to take the IOU on our retirement savings through an IRA, 401k, then that means every dollar we spend in retirement has to come back out through the Uncle Sam filter, and 14 additional areas of taxation gained or benefits lost creeps in. So the good news is, if we can simply learn to build a tax-exempt retirement or a tax-free retirement, we get to skip all of those additional taxes, all of the losses of benefits. And folks, nobody considers that when they're out trying to chase a rate of return. Everybody thinks that the key to retirement is to build the 401k balance, to go out and get a better rate of return. And what we learn is where your money is more important than what it can earn. Because in many cases, you can take income in retirement from places that create other taxes, other benefits to be lost. So the first rule should be, don't lose money. Be efficient with your money. We don't have to take more risk. We don't have to go out and invest in more risky investments because we didn't save enough money and we really need our account value to grow. No, the answer is manage those expenses. Watch what your moves with your money and your resources do within the tax code. Hopefully this brought you some eye-opening moments and some aha moments, but also hoping it give you a little bit of hope that it doesn't have to be as hard as you might have thought that it has to be. It's the game that we are playing that causes the results that we have to deal with, the rules that we follow, the costs that we incur, all of those things. This is the most important decision you can make in your financial lifetime. What is it we are building, and how does it work when we spend it? Well, if you're building like most other people in qualified retirement plans, when you spend it, it gets very, very expensive. And it doesn't have to be that way. We can pay our taxes as we go and build something that's tax exempt in retirement and keep all of the extra dollars that would have otherwise gone right out the door. Remember again, for every $1,000 of taxes or expenses that you eliminate or avoid, that's about $30,000 of portfolio wealth that you no longer need. So however you want to look at it, you either have more money than you thought, or you won't need as much money as you originally thought. Either way, this is powerful stuff. Don't ignore it. Get out there and find out.